Well, my first introduction to the markets was a discussion of cycles. I remember subscribing to the Foundation for the Study of Cycles magazine back in the late 80s and early 90s, and also, reading quite a bit about cycles. And coming from geophysics, we did a lot of time series analysis. Anything that's a function of time is called a time series. And the first thing I did was to take a look at the market and break it into its cycle components. And we do that using something called the Fourier transform. And so what I did is I took the whole Dow Jones series from 1885 to 1990. Well, this is from 1998, this picture. My first run was up to 1986. But what happens here is we can break down the market series into an amplitude versus, in this case, period. And these peaks here are labeled with how many trading days to that particular cycle and how big that cycle was. So when there's a big spike, it means that there was a dominant cycle that was present in the whole series. So here's one at 55 trading days, 148, 276. Whenever you see we call this a spectrum, amplitude versus period, or amplitude versus frequency, this is period. Whenever you see a spike in a spectrum, what it's telling you is that there's a dominant period or dominant frequency that's present in your data. So this is what the cycle people practice cycle analysis are looking for. They're looking for a dominant cycle that they can then forecast into the future. It represents a sine wave. So a sine wave forecast at 55 days means it should repeat every 55 days, and you can push that into the future and then make a judgment about whether what the market will do at some point in the future. This is cycle analysis. But it turns out that there's a deeper story here, and that is that these spikes that you see are actually linear combinations of some of the smaller spikes, a couple of the smaller spikes up above. And I show that in this slide. So 55 and 55 is about 113. This 74 spike here, 2 times 74 is 148, which accounts for this spike. And if you add 74 and 55 and 148, you get this spike at 276. So what I found out, and this was actually found this in a book on chaos theory, it's called quasi-periodicity. Quasi meaning almost, I guess, but these cycles that we see are not independent of each other. They are very dependent on a small set of initial cycles. And so the ramification of this is that in the future, your prediction of a high or a low occurring is not going to be accurate. You will only know that the market is going to change trend, but you will not know whether it's going to be from a high or from a low. And this has been plaguing cycle analysts for many years. One author used to write a footnote saying cycles can and do invert. And this is the reason for it. So the phase of the cycle is very unstable. But what I've done with Precision Turn, which is our cycle tool, is I've said, okay, well, if we can only determine whether there will be a trend change, then let's consider all trend changes as positive curvature events. So if you have a bottom, well, we'll make that, as long as the trend is changing, we'll just take the absolute value of it and we'll call it a trend change. So the higher this line is, this TMI line that we've created, the more change you get. Here it's going from a big move up to a big move down, so you get a very strong peak. Another one here. So all we're doing is we're saying, okay, I'm just gonna call it a trend change, and it could be a low, it could be high, it could be flat to up, flat to down, but it's going to move it's going to bend. The market's going to curve in one way or another. And if you do that and you eliminate the need to know whether it's a high or a low, you get a very accurate result. And so precision turn has been very good at figuring out when the next trend change dates are likely to occur. And we look also, when we do precision turn, we'll look for clusters. So we'll look for a cluster of events. Say you take all the stocks in the S&P 500 and you look at when their trend change dates are in the future, and 5 or 10% of those names all cluster on the same date, that becomes a significant market event. So that's how we've solved the cycle problem. And I believe that is, let's see. And yeah, so to wrap things up, we've looked at all the manifestations now of complexity theory as evidenced by market prices. So quasi-periodicity accounts for price cycles. Critical phase transition, where the market organizes itself to critical points. We have extreme Hurst for that. Precision turn for the cycles. Self-organization emergence creates the geometry. We have smart channel for that. And the pursuit of price involves volume moving in the direction, volume increasing in the direction that price is moving. And we have volume trend for that. So we've narrowed down really the key predictors for all the observables that compose technical analysis. And the next thing we'll move to is a discussion of our fundamental model. That'll be the next slide.